Groundfloor is a real estate wealth tech platform that specializes in short-term, high-yield real estate debt and functions as a bridge between everyday investors and residential real estate developers. Instead of focusing on equity where someone owns a piece of the property, Groundfloor focuses on limited recourse obligations, which are commonly known as LROs. By participating in this platform, an investor is essentially acting as the bank for residential real estate flippers and developers. This fills a massive gap in the market because most high-yield real estate platforms are restricted to accredited investors or people who already have $1 million net worth. Groundfloor uses SEC Regulation A to allow anyone in the United States to invest, which makes it an incredibly accessible tool for the average person looking to diversify away from the stock market. The core of the experience revolves around picking individual renovation projects to fund through LROs, which typically offer returns between 5% and 15% with terms lasting anywhere from 6 to 18 months. For those who prefer more predictability, the platform offers notes, which are fixed-term portfolio-backed debt products with set repayment dates. These notes usually provide returns between 5% and 8.5% over periods of 1, 3, or 12 months. There is also a feature called Flywheel, which handles automated diversification across various loans to help keep money working constantly. One of the biggest pain points for new investors is the high cost of entry into real estate. Groundfloor solves this by offering a low barrier to entry where people can start investing with as little as $10 or $100 depending on the specific product. This is significantly lower than many competitors that require thousands of dollars just to get in the door. It is also a very strong alternative to traditional bonds or high-yield savings accounts because earning 10% or more on debt-backed investments is a very attractive yield in today's economy. Unlike equity real estate investment trusts that might lock money up for 3 to 5 years, these loans usually pay back in 6 to 12 months, which provides much better liquidity for the user. Every loan is also backed by the physical property itself, so if a borrower defaults, the platform can foreclose on the property to try and recoup the funds. However, there are serious factors to consider before jumping in. These are fix and flip loans, and in a cooling housing market, borrowers may fail to finish projects or sell them for a profit. Even though the platform forecloses on behalf of the investors, it is still possible to lose principal investment. There is also a risk regarding a lack of initial diversification. If someone only picks 2 or 3 loans and one of those fails, it will significantly hurt the portfolio. To mitigate this risk, an investor really needs to spread small amounts of $10 each across 50 or more loans. There is also no secondary market for these investments. Unlike a stock that can be sold on an exchange if cash is needed tomorrow, these funds are locked until the borrower repays the loan at the end of the term. The complexity of the LRO grading system is another point to watch. Groundfloor assigns grades from A through G based on risk. A newer investor might not fully understand that an A-grade loan offers a lower return because it is safer, while a G-grade loan offers a high return because it carries much higher risk. It is also important to remember that these returns are generally taxed as ordinary income rather than at lower capital gains rates, which might be a disadvantage for some tax strategies. This platform is a great fit for someone who wants passive real estate income without managing tenants and who is comfortable with moderate risk in exchange for those 8 to 12% returns. It is not the right choice for someone who is extremely risk-averse or who needs their money back in a few months because project delays can and do happen. Using the flywheel or auto-invest feature is generally the smartest move for beginners because manual picking is time-consuming and often leads to poor diversification. To wrap things up, Groundfloor is a unique way to act as a lender for real estate projects with high yield potential and low entry costs, but it comes with the inherent risks of the real estate market. The primary risks involve borrower defaults, the potential loss of principal if a property does not sell for enough to cover the debt, and the lack of liquidity during the loan term. While the asset-backed nature of the loans provides a safety net, it is not a guarantee of profit, and investors must be prepared for the possibility of delayed repayments or project failures.